Okay, right. So now, because you understand the principle, you shouldn't be shocked by any type of question that tells you, oh, something's happened, and so you are required to enter that entry in the sales ledger control account. Remember, the sales ledger control account is just a total of the trade debtors, and the purchase ledger control account is just a total of the trade creditors. So, for example, if you were told, oh, let's just go back, for example, let's create a scenario, Pi and Po, and we have the sales ledger control account, and we have sales. And let's have the scenario where we have sales, we have Pi, who owes us 500, we have 1,000, and we have sales of 1,000. Yes, you can see this is, we're talking about the sales ledger control account, sales here, sales ledger control account, and those are the individual accounts in the sales ledger, for Pi and Po. Now, we have already discussed what happens if you receive the money, so let's just say you receive 500. I'm skipping the cash book now, but if in my cash book we had a total of, we received 800, no discounts, we just received 800. So if this is my cash book over here, and we got 500 from Pi, and from Po we got 300, I would take the 800, wouldn't I? And I'll put the 800 here, and I'd open bank and put the 800. Right, this is a subsidiary book, so I'm just writing in this space, but this is not a T account. This is a subsidiary book, the cash book. This is the T accounting. The bank, debit bank 800, credit sales ledger control account 800. Those are the two events happening, 500, 300, 800. Now, what if you heard that Po was now bankrupt, and it was a bad debt, and Po would not be able to pay you? Well, this is an adjustment. Well, technically right now Po owes us £200, but Po can no longer pay us. This account must close. So here in our sales ledger control account, it also says that we are owed but we are no longer owed 200 because he's now bankrupt. And remember, what we do is we open up, if you like, yes, I'm looking for some space. I'm going to do it up here. Open up a bad debt account, don't we? And since Po is now gone, it's an expense, debit 200 and credit 200, bad debt. Right? Well, I mean, obviously you must put 200 here as well, but this is the double entry here. This is just fulfilling the journal, or just updating a journal or a diary, if you like. This is just updating a diary. We're not doing anything special. We're just sort of saying this mirrors this. Yes, but this is the double entry. Create all happening in the general. This is in the general ledger, this account, the bad debt account. Debit 200, and there we have. So typically, the bad debt account would be made up of individual journals, because there's no subsidiary book per se to get a total, to get all the information into bad debts. It's really just, this individual journal entries that must hit the bad debt account, and that's that. Really. So it's very possible to see in your sales ledger control account 1,000 from sales, showing people owe you money, receipts, but you will see discounts allowed, and you can also see bad debts. Right? So this one was on bad debts. I'll do another one on another thing that can happen. But the key point is not to panic. It's just always to think whatever can happen, affect all the things that can affect a trade credit transaction. You sell on credit. Well, you sell on credit. You could get goods returned back to you. You could get paid for the goods that you've sold. The person who you sold to could go bankrupt. Yes, and those are some of the situations that you should be sort of aware of. Okay, we'll look at one more in the next lecture. See you then.